financial markets remain the key risks to global economic stability. On the domestic front, the economy is on a path of moderate recovery in a positive short to medium-term outlook, premised largely on fiscal stimulus and a stable naira exchange rate. Inflation expectations also appear sufficiently anchored with the current stance of monetary policy. In attendance were 8 out of 12 members of the committee. Committee examined the global and domestic economic and financial environments in the first half of 2017 and the outlook for the rest of the year. The external developments. The momentum witnessed in the global economy during the first quarter of 2017 continued through the second quarter, driven by a generally accommodative monetary policy stance in most advanced economies, moderation in energy prices, and improved global demand. The emerging markets and developing economies are experiencing positive spillovers from somewhat improved commodity prices and developments in the advanced economies. The growth prospects for this group of countries in 2017 are expected to rise to about 4.6% from 4.3% in 2016. Complemented by the momentum in other blocs and a potential positive prospect for expansion in world trade, the International Monetary Fund, in its July edition of the World Economic Outlook, projected global output growth in 2017 at 3.5% from 3.1% in 2016. The Monetary Policy Committee, however, noted some headwinds confronting the optimistic outlook to global growth, arising mainly from receding market expectations of expansionary United States fiscal policy, weaker than expected growth in the UK due to difficult Brexit negotiations and geopolitical risks associated with the forthcoming German general elections. In addition, the committee noted the downward trend in global inflation after earlier indications of an uptick as the United States continues to build up inventories in shale oil, while emerging economies such as Brazil, Russia, and South Africa witnessed strong economic headwinds, leading to sharp downturn in outputs. Data from the National Bureau of Statistics showed that the contraction in the economy moderated to 0.52% during the first quarter of 2017 from 1.3% during the fourth quarter of 2016. The data further revealed that 15 economic activities recorded positive growth during the first quarter of 2017, showing strong signs of recovery. The Purchasing Managers Index, the PMI, for manufacturing and non-manufacturing activities stood at 52.9 and 54.2 index points in May and June 2017, respectively, from 52.7 and 52.5 index points in May 2017, indicating an expansion for the third consecutive month. Similarly, the composite index of economic activities rose from 55.85 to 59.50 index points between April and June 2017. The committee noted the continuous positive effects of improved foreign exchange management on the performance of manufacturing and other economic activities. Non-oil real gross domestic product grew by 0.72% during the first quarter of 2017, reflecting growth in the agricultural sector by 0.77% in the same period. Provisional data also showed that the external sector remained resilient during the second quarter of 2017, as the overall balance of payments position recorded a surplus of $0.65 billion, equivalent to 0.8% of GDP. The committee noted that the implementation of the 2017 Budget and Economic Recovery and Growth Plan will further strengthen growth and stimulate employment. The committee noted that money supply M2 contracted by 7.33% in June 2017, annualized to a contraction of 14.66%, in contrast to the provisional growth benchmark of 10.29% expansion for 2017. The development in M2 reflected a contraction of 7.45% in net foreign assets in June 2017. Similarly, M1 contracted by 7.98% and 10.70% in May and June 2017 respectively, consistent with the directive of the MPC that expansion in narrow money should be controlled. On the other hand, net domestic credit grew modestly by 1.02% in June 2017, annualized at 2.04%, driven mainly by net credit to the government, which grew by 5.91%. Credit to the private sector, however, declined relative to end of December 2016 by 0.02%. The MPC noted the widened fiscal deficit of 2.51 trillion naira in the first half of 2017 and the growing level of government indebtedness, and expressed concern about the likely crowding out effect on the private sector investments. The constrained growth in monetary aggregates provide evidence of weak financial intermediation in the banking system arising from the constraints imposed by the macroeconomy. Headline inflation year-on-year declined for the fifth consecutive month in June 2017 to 16.1% from 16.25% in May and 18.72% in January 2017. Core inflation moderated to 12.5% in June from 13% in May 2017, while the food index rose marginally to 19.91% in June from 19.27% in May 2017. This development was traced to intermittent attacks by herdsmen on farming communities, rising incidents of terrorist activities in the northeast, and other seasonal farming effects. The committee was particularly concerned about the unabating pressure from food inflation, but remains hopeful that the situation will dampen in the third quarter as harvest begins to manifest. The committee also attributed the moderation in inflation to be partly due to the effects of the relative stability in the foreign exchange market, stemming from improved management, which promoted increased inflows. Against this backdrop, the committee reiterated its commitment to sustain and deepen flexibility in the foreign exchange market to further enhance foreign exchange flow in the economy. Committee, however, noted the protracted effect of high energy and transportation costs, as well as other infrastructural constraints on consumer price developments, and expressed hope that government will fast-track its reform agenda to address these legacy issues. The committee noted that while responding to the current tight monetary policy stance, inflation still had a strong base effect, which is expected to wane by August 2017. Money market interest rates moved in tandem with a high level of liquidity in the banking system. The interbank core rate opened at 16.13% on May 25, 2017, and closed at 4.43% on June 29, 2017. However, the average interbank core rate during the period stood at 12.49%. The movement in the net liquidity position reflected the effects of open market operation, foreign exchange interventions, statutory allocation to state and local governments, and maturity of Central Bank of Nigeria bills. The committee noted the improvements in the equities segment of the capital market as the all-share index rose by 33.33% from 25,216.34 on March 31, 2017 to 34,020.37 on July 21, 2017. Similarly, market capitalization rose by 32.84% from 8.83 trillion to 11.73 trillion during the same review period. Relative to the end of December 2016, capital market indices rose by 26.59 and 26.81% respectively, reflecting growing investor confidence due to improvements in foreign exchange management. The committee, however, noted the seeming bubble in the capital market and cautioned on the utilization of the inflows. Total foreign exchange inflows through the Central Bank of Nigeria increased by 35.41% in June 2017 compared with the previous month. Total outflows, on the other hand, decreased by 12.73% during the same period as a result of reduced CBN intervention in the interbank foreign exchange market, which also reduced the TSA dollar payment balances by 61.4% in the month under review. The positive net flows reflected in an improvement of gross external reserves to $30.3 billion at the end of June 30th, 2017, compared with $29.81 billion at the end of May 2017.